I'm super excited to kick the day and the conference actually. So I will speak about cryptodollars and the hierarchy of money. And the whole idea of this presentation is to give you some concept to think about the presentation you will see for the next 2 days. So it will be an opportunity for you to just think, well, maybe I'm saying some stuff that are wrong, you agree, disagree, but at least you have the framework to try, if I succeed, to think more critically about what you will see for the next 2 days. Oops. So first, if you want to have the slides, you can go to my Twitter. It's the last post, so you can download the slide and watch them later or while we are doing the presentation. So I'm doing what I call crypto banking, which I'm good at because I'm probably the only one who uses this term for what it means. I started to work at MakerDAO 3 years ago, doing a lot of financial reporting, real-world asset, and so on. And I co-founded with my 2 other partners, Steakhouse Financials 2 years ago, which is a crypto-native financial advisory, and we work for some of the best DeFi protocol. So the first concept I want to submit to you, and again, it will be my definitions, but you might disagree, but it's important just for the rest of the presentation, the difference between stablecoins and cryptodollars. So I will define stablecoins as on-chain issued liabilities that promise to maintain value relative to reference assets. So anything that said, well, I promise to keep the peg, that's for me a stablecoin. Some will not keep the peg, obviously. And the difference is when you are speaking about cryptodollars, those are stablecoins that are redeemable for what I will call higher level money. And we will see later the hierarchy, but it's just something closer to the reference asset. If you are a stablecoin in dollars, for instance, it could be any reference asset, but we will always use the dollar. It's just to say, well, if you are, for instance, USDC, you can redeem for a bank deposit, which is still not the pristine collateral, the pristine reference of money. So cryptodollars are a subset of stablecoin. I'm not saying that other stablecoins are not important, they are, but for this presentation, I will just focus mainly on cryptodollars. So the hierarchy of money, you can see here what the term was created by Perry Merling that you can see on the bottom. A nice MOOC if you have some time to follow. This is a hierarchy of money during the gold standard. We are no longer in the gold standard, but it's making stuff more easier to follow. So real money was gold. Gold was the most important stuff. Then you have currency, US dollar, pound sterling, that were pegged to gold until they weren't. So they were IOU of gold. So obviously it worked until it didn't. Then underneath you have bank deposits. Bank deposits are promised to give you currency on demand, and it works until it doesn't. And at the bottom you have the cryptodollars. Well, as you can see that when you are going up, it's more look like money, and we speak about moneyness. And when you are going down, it's more looking like credit, because it's an IOU of an IOU of an IOU. So there is more risk. What is interesting is I can see that at the top, we have gold, but we are quite limited in the supply of gold. And at every layer of the hierarchy, you can create new money. You can increase the money supply. And so that's the concept of elasticity, where each layer can increase, and discipline, where there is a crisis or something like that, where people are redeeming, and people want to go up to the hierarchy because they have a stress, and they want to be more safer. So, another concept related to this money creation is fractional versus full reserves, stablecoins, banking, whatever. Full reserve, which is this balance sheet here, you have lower level money, so the stuff on below, which in your case will be stablecoins or cryptodollars. And on the asset, you have higher level money. Higher level money, for instance, for USDC, you will get bank deposit, T-bills that we will include in full reserve, and same for PyUSD. For fractional reserve banking, it's a bit different. You have the lower level money, so your stablecoin, but you don't have 100% backing buy higher level money. So you might make some investment on the side, which have longer maturity. It's less liquid than money because you cannot redeem for just, I don't know, a loan in the US. And so there is some risk. And that's why usually when you have fractional reserve, you have some equity buffer to sustain the fluctuation of those investments. You can also have no reserve, and that's, for instance, maker at the beginning, or liquidity still, where you don't have any of the higher level money, so you cannot redeem. Those are just stablecoins that are not crypto dollars. And obviously, there the peg is a bit more difficult to manage. I just don't see the time, so I don't know how much I'm doing on time. So just to show you the hierarchy of money with some fancy colors, so similar to what we saw 2 slides ago. At the top, you have the Fed reserves, so the dollar notes and the reserves at the Fed. Underneath, you have the US bank deposit, which are fractional reserves. You can have USDC, which is full reserves, and DAI underneath, which is currently more fractional reserve, because there are some crypto-backed loans. And you cannot redeem DAI for crypto-backed loans. That wouldn't make much sense. But you can, from DAI, redeem into USDC. From USDC, you can redeem to bank deposits. And from the bank deposit, you can go to your bank and get US dollar notes. We also have here the euro dollars, which are just non-US bank deposits. And Tether, for instance, is more likely using more non-US bank deposits. Another concept that is important for crypto dollars is the difference between the primary and secondary market. Why is that? If you look at the literature, a lot of people are saying, well, stablecoins are not stable. They are not always at $1, for instance. It's always fluctuating. But is it really? What is interesting is that they are always taking the secondary market price because it's the easiest one to find. You go on the Uniswap, on Curve, whatever DEX you want, or even on centralized exchange, you will not get one-to-one. There will always be a small spread just because that are arbitrageurs, market makers. So primary market is the value that you get at the issuer of the stablecoin. And if you look carefully at Circle, you always get $1 per USDC. And the opposite. For $1, you always get 1 USDC. And I found no case in time where it wasn't the case. If you look at DAI, at Maker, you can always redeem for 1 USDC, currently, or mint the other way. On secondary market, it could be different. Why? Because it's driven by supply and demand, and you are expecting arbitrage opportunities for people to arbitrage. So both the primary and secondary markets are important for crypto dollars, but obviously if you don't have a strong primary market, you might fail to have a secondary market. But it's not because you have a good primary market that you will be good on secondary market neither. Let's say you are issuing on Ethereum, and some people want to buy or trade your stablecoin or crypto dollar on another layer 2 or another layer 1. There are bridging issues, there are delays, and so the price can fluctuate. Although there is some market element that makes it a bit difficult to have a proper price. First, the spread that you have on a decentralized exchange. And if you look just at the DAI, you can see that at one point, there is many prices. And sometimes it's quite fluctuating, just because arbitrageurs cannot do the arbitrage quickly enough, or there are some other technical reasons. So we discussed that the crypto dollars can be redeemed for higher level money. For DAI, let's say it will be USDC. For USDC, it's a bank deposit. So now we can look, well, is it yours, this facility? Is it that important, and what is happening? So here on the right, you have 2 charts where you can see in a blue the gross outflow, meaning for a 30-day period, how many percentage of the market outstanding supply was redeemed. And in purple, you can see the net redeem, meaning over 30 days, how much of the outstanding supply was redeemed minus what was minted, which is more or less what is a decrease in the outstanding supply. What you can see is that there is a lot of redemption as the primary issuer, as the primary market, up to 60% when there is a stress. When there is some volatility in the market, it's more likely than people are redeeming. But it's not because a lot of people are redeeming, then they want to decrease the supply of your stablecoin. Actually, if you look at the net outflow, you can see that most of the time, both for DAI and USDC on the bottom, it's usually way below 20%. It's only when there is a big stress, which for USDC was obviously SVB. After SVB, a lot of people redeemed. Funnily enough, if you look at DAI, there was a lot of gross redemption during the SVB incident, but no net outflow, because actually there was a lot of inflow. So 20% seems the threshold where you are usually quite safe, or somewhat safe, except on major events. So that makes pose the question, well, maybe fractional reserve is enough, because most of the time you have only 20% net redemptions. So what is the right threshold? Obviously, it's not 20%, because we can see that it goes up to 30% from time to time, but maybe fractional reserves is enough to remain safe. One key item that I'm quite interested in is what they call singleness of money. If you look, so singleness of money allows within a hierarchy of money to move from one financial instrument to another frictionlessly. So we saw a few slides ago the hierarchy of money. The question is, can we go from DAI, the stablecoin, to a dollar note easily or not? And what is also important, if you look in TradFi, you have euros, for instance, because we are in Belgium. You have euros. You don't have BNP Paribas euros. You don't have ING euros. You just say, well, I have euros. Because it's so easy to transfer €1 from one bank account to another, or to a physical euro, that you don't think too much about, well, is it the same or is it different? When we are going to DeFi, it's actually quite different. You never pay in euros in DeFi. If you go on Uniswap, even if you use Circle Pay or any payment method that there is, you never pay for euros. Or at least what you pay usually is, well, you will pay in Euro A, the Angle stablecoin, Euro C, the Circle one, or Euro CV, the Société Générale one. And they're all euro-based stablecoin. So there should be €1. And at the primary issuer, they have €1. But you cannot pay, for instance, with Euro CV one-to-one when the price is expressed in the Circle stablecoin. So that is quite an issue. And what I'm proposing is that the problem is not the lack of CBDC. Obviously, central bankers are always saying that CBDC are needed. But it's not, because the singleness of money existed way before central banks. So there was already ways to fix the problem. Actually, regulation is quite of an issue for the singleness of money, because, for instance, if you look at a regulated stablecoin under MiCA or under other framework, they are not allowed usually to keep cryptodollars of their competitor. But even if they could, usually they don't want to. I worked quite a lot to try to have a DeFi stablecoin keeping some liquidity reserves in other stablecoin from their competitors. And I can tell you it's quite challenging for one stablecoin to keep some exposure to another stablecoin, just because of the competitive issues. If you look at the, let's start with this one. So if you look on this one, you have the banks, which are, you can convert from one to another. It's TradFi, so it's slow, it's painful, and sometimes it's a bit costly. Still one-to-one, but with fees, as TradFi does all the time. And just on the line below, you had fiat-backed stablecoins. So you have the PyUSD, USDC, and USDT. And from those, you cannot convert one-to-one. It's just not possible. You can go on Curve, you will get a great price, but it's not one-to-one. So they are not the same. If we go one level below, you have the DeFi stablecoin and just represented DAI and USDA, so the angle one. And you can see that those have liquidity reserves in USDC. So you can always go from DAI to USDC one-to-one. At the same time, you can go from USDA to USDC one-to-one. And so that means that with those two properties, you can now go from USDA to DAI one-to-one. And here is a transaction that I made that I didn't execute because I didn't have 1 million. But you could use 1 million USDA to 1 million DAI, and it's exactly one-to-one. 2 years ago, it was possible to convert up to 4 billion from, for instance, DAI to USDC. Now it's no longer the case, but I hope we will improve the system, and there are many ways to get better. So I will just leave you to this slide, just to think again about the hierarchy of money. So we have the old one, the Fed, the central bank, the US bank, the non-US bank, which are euro dollars. Maybe in the future, we will get just the crypto-dollar hierarchy of money with fiat-backed stablecoin, free reserves under the central bank, and then the fractional reserve underneath. Thank you.